Let's revise monetary policy tools or credit control tools, starting with quantitative or general credit control tools. First one, open market operations. Under this, RBI will either sell government securities or purchase government securities according to the requirement. If RBI wants to change the money supply permanently, it will conduct outright OMO. If it wants to change the money supply for short duration, it will conduct repo and reverse repo. Under repo, RBI lends for short duration and charges rate of interest, that is repo rate. In the reverse repo, RBI will borrow for short duration, pays a rate of interest, that is reverse repo rate. Second one, standing deposit facility. It has been introduced based on the Urjit Patel Committee recommendation, wherein banks will deposit for short duration with Reserve Bank of India, will earn rate of interest. RBI doesn't have to provide any kind of collateral when they collect the deposits. And this is available throughout the year. Third one, marginal standing facility. Banks are facing emergency. They want to borrow for overnight purposes. They can go to RBI, deposit collateral, and borrow for short duration. RBI will charge a rate of interest above and over repo rate. Next one, cash reserve ratio. Percentage of NDTL, net demand and time liabilities, that the banks will have to deposit with Reserve Bank of India, generally fixed in the range of 3 to 15%. On this, RBI does not pay any rate of interest. Fifth one, statutory liquidity ratio, SLR. It represents percentage of NDTL that the banks will have to keep with themselves, either in the form of cash, approved government securities, or in the form of gold. Banks generally keep this in the form of approved government securities. Sixth one, bank rate, purely a lending rate. RBI lends money, charges rate of interest. In addition to this, please remember the standing deposit facility, repo, etc. are part of liquidity adjustment facility which has been introduced based on the Narsimham II committee recommendation back in the year 2000. Next, quantitative or specific set of tools which are used to regulate money supply targeting specific sectors. First one, priority sector lending under rationing of credit. Under this, the banks will have to ensure 40% of the loans which are given to total 8 sectors. Most of the banks it is 40. For some banks, it will be more than 40. Second, regulation of consumer credit. RBI will regulate access to certain types of loans which are given for consumer segment. This will ensure either more loans are given or lesser loans are provided. Third one, variation of margin requirements. Whenever you take a loan, you'll have to make certain part of contribution of the loan from your pocket. That is down payment, margin requirements. RBI will ask the banks to change it according to the requirement. The fourth and fifth one, direct action, moral suasion. Under moral suasion, RBI will direct the banks, will ask the banks, will warn the banks to follow the guidelines. If they don't, then RBI will take a direct action, penalize, impose a higher rate of interest, etc. These are the set of the credit control or monetary policy tools.